Hey, everybody. I think there's some really good opportunities in the basis markets here recently. And if you don't know what basis markets are, just stick with me and I'll explain those in a second. But just kind of know for right now, if you're maybe a little bit nervous about trading futures, especially those big flat price contracts like crude oil or heating oil, there are different ways of getting into the market at much lower risk and much lower margins. And I want to explain that to you this week. Hey, I'm Aaron Kildow with 30 years of experience in oil trading and analytics, and I'm here to elevate your understanding of the oil market. All right, so let's jump into it here. All right, as usual, we'll start with our WTI futures contract just to kind of show you what's going on. This week, we were able to bounce back a little bit. We got up, we settled just above $60, I think for the first time in 11 days or something like that. So a little bit of progress. We've got two up weeks in a row, although relatively small. This week, I gave you a really long scale timeline here so you can sort of see where we've been and what we're up against. Again, I'm thinking these two lows here might be something of a double bottom. We'll see going forward. Again, we're going into a time where we're maximizing refinery throughput for just a few weeks. And then by the time we get into January, that's all going to sort of start to evaporate again as planned maintenance season kicks in. So we've got a couple weeks of max demand, and then it really starts to deteriorate quickly right after New Year's. So it'll be interesting how the market views this. Is it just going to look through this period of relative strength into the period of crude weakness from a crude perspective? And on the other side, we're going to talk about this more on the product side. Obviously, if you have lower refining rates, then you're going to be creating less refined products. So, it should be getting stronger and that sort of thing. So anyway, it should be pretty interesting to see how this plays out. We're still relatively bullish on this market. Again, it's a shortened time period that we have to work with, only a couple more weeks here, but hopefully we can get some markets to move a little bit higher here in the next few weeks. But really like I said before, what I want to talk to you about this week is basis markets. And I thought this was a great place to start. This is the LT futures market. So think of it like this, a basis, at least in terms of the oil market, you're talking about one location versus another. And that's why I wanted to start out with the diesel market, because in this case, there's no quality differential. It's the same quality barrel in the Gulf Coast and in New York Harbor. It's just there's a location differential. And so if you think about it, the futures contracts, the big ones, the crude oil, the heating oil, or the ULSD contract is what it's referred to now, and the gasoline contract, those are pretty big futures markets that anybody can sort of get into. And so they become large because you can get lots of speculators in there. You can get hedge funds. You can get commodity pool operators. So in other words, speculators coming in, and speculators do add an important role into the market. You get your refiners who are looking to maybe lock in refining margins every once in a while, but especially on the diesel side and residual fuel side, you'll get people who are the end users and they're trying to lock in really low rates because they've got maybe a trucking operation going on, something like that, where they know they're going to need X amount of fuel for the next year or so, whatever the case may be. And so they're looking to try to buy when the market's low for the rest of the year and lock in those low rates before things get crazy again. So there's all sorts of reasons for a lot of people to be looking at those bigger contracts. But then you start looking back sort of where does that come from? So as you may know, Pad 1 or the East Coast is chronically undersupplied in terms of its regional refinery capacity. We've only got, less than 1 million barrels per day of refinery capacity on the East Coast, but you can easily have 3 million barrels per day of gasoline demand. And, if you think about it, gasoline demand, for just straight from the refineries, about 50% of the output, 50, 60%, something like that. So it's obvious from there, your refinery throughput just from the refineries, you're talking maybe 500,000 barrels per day, trying to supply a 3 million plus million barrel per day market. So they're dependent on other markets to help supply them. The biggest market that helps supply them is the Gulf Coast, where nearly half the refining capacity in the U.S. is located. And there's a couple of big pipelines, Colonial Pipeline being the biggest, which we've probably talked about before, and maybe you've even heard of before, given, they've been had some big headlines in the news in the past couple of years. But that's the main corridor from where you take gasoline from, say, the Houston area refining segment and you pass it all the way up into New York Harbor. There's a couple other smaller pipelines that do similar things, but Colonial is sort of the main one that people sort of typically think about. And so there's truly a location differential. So to bring it back to the diesel fuel, because it's you're actually talking apples and apples in terms of quality, it's just a location differential. So there's a tariff on that pipeline, which is, just under 8 cents or so right now. And you can sort of see here in this bigger chart of the LT futures that that's kind of where it likes to hang out. Under normal circumstances where you don't have any odd supply or demand issues in one region or another, the market's sort of balanced, if you will. It's balanced in the Gulf Coast and it's balanced in the East Coast. It's going to try to hover right around that 8 cent mark or so and try to keep that pipeline arb open a little bit when it needs to, but mostly right on the ragged edge of closed and that sort of thing. And there's a lot of games that go on in doing that. But what I want to point out is usually in December, and you can see back here in 2023, just a really crazy example of what happened. The basis market, so the differential between the Gulf Coast and New York Harbor, just absolutely blew out back in 2023. And so the way we're looking at this, and you can see here, maybe it's called an up-down future, again, referring to the pipeline. So the way this is configured and the way most basis markets are configured is you take the main point as being the thing that you're subtracting from. So we're subtracting New York Harbor, or sorry, we're subtracting the Gulf Coast from New York Harbor. And so we get, right now about a 15, 16 cent discount in the Gulf Coast. So the diesel fuel, which again is chemically identical to what's being traded in New York Harbor, is 16 cents per gallon cheaper in the Houston area right now for reasons we're going to go over here just in a minute. And the main differential should be that pipeline tariff, which again, you're almost right now paying double. So then you sort of have to ask yourself, well, which is it? Is New York Harbor really strong and the Gulf Coast is just kind of doing what it should be, or is New York Harbor just kind of doing what it should be and the Gulf Coast is super weak? And I think it's the latter going on. Again, there's a lot of this tends to happen in the month of December. There's ad valorem taxes, especially in Texas, that find themselves that come into play here, where you want to get your inventory by the December 31st. You want to have your inventory at sort of a minimal level. And so if you can book these Colonial Pipeline cycles right, you can get most of your products shipped out and headed out of state already, going towards customers in the East Coast. And then it's not your problem. It's not counted as part of your inventory that you would be taxed on by the state of Texas at the end of the year. Now, some people take their ad valorem at the end of August. Some people take it at December 31st, but it seems like December 31st is the big one that moves the market. And you can see back here, that's what was going on in 2023. Again, now flat price was a lot higher. And so what they're going to do for the ad valorem tax is I think it's around 3% times the value of that barrel on December 31st. And that's what they're going to tax you on. The reason why this kind of came off a little bit before the end of the year, again, is you're trying to time it just right to get on that colonial pipeline cycle and get out of the state and the title switching hand to someone else. So it's not in your inventory, so it's not counted against you. So that's why the timing's a little bit off. Maybe you would think it would be the last day of the year. It's not. It's going to be a couple weeks before that, which puts us to where we are now. So maybe this upcoming week, maybe the week after, we continue to see more weakness in here. It's probably this next week is going to be the weakest, I would imagine, because again, those cycles are coming up pretty fast here to get product actually, a change of title, so it's no longer yours and get it out of town. But that brings the whole curve down. So this doesn't happen in isolation, and that's what this sort of inset chart is meant to be. So the blue line here is the forward curve as of Friday on the LT contract, the Gulf Coast ULSD Up-Down on the forward market. So we're talking about December being the weak point, and if you were to trade this If I was trading this, I wouldn't touch December with a 10-foot pole because it's lightly traded. There's so much volatility in it, et cetera, et cetera. A lot of crazy things going on. I would be looking at this Jan or February contract saying, well, that's still really far below this dash line, which is approximately what the pipeline tariff is. And you can see in the summertime how the forward curve is already trading right to that forward or right to that tariff value, right? So making it really hard on shippers trying to move barrels from the Gulf Coast to New York Harbor efficiently. So I would be looking at the Jan or Feb if I was going to be trading this from a long perspective. So sort of the weakness in December is going to pull that whole part of the curve down, if that makes sense, into Q1 and allow you some pretty good entry points to get in. And we're going to go through the inventories here in just a second, but I wanted to point that out as maybe an idea for you. If you have a futures account set up, you'll see if you can go through it and even on the CME website, just look for the LT contract. You can search for that, and you can see the margins are way lower than sort of like the heating oil margins for the full contract, right? So, just putting it out there, is that something that's interesting to me? That's something I would be trading. You've got your own decisions to make, but I just wanted to point that out as something sort of, it happens this time of year, and I'm pointing it out to you as it doesn't usually stay like this very long. You can see how quick it bounced back in 2023. In 2024, where are we here? We didn't get nearly as big a move in 2024, but we are getting a decent sized move this year, and I'll show you why here in just one second. But it's not just the refined product markets that have basis. You also have different basis in the various grades of crude oil as well. And so here, this is the HTT contract. This is the Houston WTI contract. So again, there's also a Midland WTI contract. There's the big CL contract, which is just a light crude contract that's traded in Cushing, Oklahoma. A lot of times we refer to it as the WTI, but in actuality, you can make a synthetic blend as long as it meets the criteria that the CME set out for what light crude means, which again, you can go to the website and you can check that out yourself. There are people that blend other things in WTI. There's usually some TI in there, but blending in other things that are much cheaper and delivering that to the screen. And that's perfectly legitimate as long as you're meeting all those other ramifications, all those other parameters. So what I'm trying to say is there's several different, again, basis markets. So now this time we're talking about WTI in the Houston market. And you can see by the scale, it doesn't move a whole lot. But again, we're going into this period where the market's relatively going to be tight over the next few weeks. I would imagine that the basis market would sort of continue to appreciate. Now, there is a bit of tug of war because, again, it's the same ad valorem issues as you have with the Gulf Coast heating oil, with the LT contract. Traders are going to try to get rid of this physical oil while they can to sort of minimize their inventories, to minimize that impact that tax bill has on them. That being said, refinery demand should be very strong. We're still seeing really good margins for all of this anyway, given these weaker margins in HTT in LT and whatnot. So what makes this interesting is going then into the month of January and February, where we do have pretty large turnarounds. You would think this would, again, sort of soften up and have a similar sort of feeling where if that market gets too weak in the calendar months of Jan and Feb, maybe the trade is to look for ways to get long for the middle of the summertime when you know refining demand is going to be sort of maxed out. So that's maybe a little bit different way that you can look at the basis markets. A different maybe another aspect of it, again, is this is going to be where you would start if you were trying to export the marginal barrel. So if you were a crude producer, like one of the big integrated crude producers that have pipeline capacity and all this sort of thing, they're going to start with the value that they assign pulling the crude out of the ground and trying to decide what to do with it. Sometimes exporting it is the best thing. Sometimes exporting it for the sake of trying to build up a market in whatever foreign country it is you're trying to export to. Maybe that's a goal, and you sort of ship through rough times just to kind of keep that end user happy in that foreign port, wherever they are. So what I'm talking about, I'm not talking about that. I'm talking about the marginal barrel when there's just too many barrels around and you need to clear, or you get the same thing going on where maybe the Brent market's super strong for a different reason, or the Gulf Coast market's super weak because our refinery demand is really low, like what should be coming up here in the calendar months of Jan and Feb. And you get these imbalances where the marginal barrel now, the next barrel coming out of the pipeline, needs to get shipped someplace else, or there's an opportunity to ship it someplace else because of these arbitrage opportunities. So that's another thing to sort of watch out for. Now, Europe is going to have some planned maintenance going on at the same time we do here in the Gulf Coast. But again, you're not necessarily looking for the weakness in Jan and Feb. You're trying to leverage the weakness in the months of Jan and Feb to get you into a cheaper way of buying midsummer basis when it's going to be stronger, if that makes sense. So again, if you look here in the middle of the summertime, back here in the middle of the summer, this HTT, the Houston WTI, gets relatively strong. Then you kind of get a sell-off into the end of the year. It starts to bounce back. Sometimes there's some freeze-off issues going on in January. As you can see back here in 2023, the market really spiked and then came back down as our first concern was about getting crude out of the ground because Midland was freezing. The second concern was, oh no, now we've got refineries that are out in the Houston area, right? And so that caused that. So then you lost supply, so the market popped up, but then you lost a lot more demand, and it took a lot longer. So there's all sorts of uh, things that can happen in these markets, but again, it's going to be a much smaller margin than what the full size contracts are trading, like a crude oil contract. The HTT margin is much smaller, and you can see the scale on this is relatively small. So you'd have to have a decent position on, or really catch a good move to make a lot of money on it. But it's a fun, and it bounces around, and you can make some decent, singles and doubles, if you understand what I mean, off of these basis markets. So just again, pointing that out to you, just trying to explain what basis markets are and maybe some trading opportunities around them, at least the trading opportunities that I'm looking at. In terms of what's going on the inventory side, so looking again at Pad 1B, which is New York Harbor, this is where the futures are set to. So you would deliver futures to this if you went out short on the futures contract, not on the basis. So you can see that both are relatively low, especially on the distillate side. Going into the winter months, we're at the bottom of the 5-year range. So I think it makes sense that the New York Harbor market at the end of the pipeline would also be relatively expensive versus other things, and the Gulf Coast should be relatively cheap because we're low on inventories of distillate in New York Harbor at the end of the pipeline. And again, from a heating oil perspective, this is where people actually use heating oil, right? Is in that Pennsylvania, New Jersey, New York area, and further north into New England as well. Where in Texas we don't use distillates almost at all for home heating. It's mostly propane or natural gas or electricity. So then looking at the Gulf Coast, you can see these markets are really well supplied. So gasoline, we're already at the top of the 5-year range. On gasoline, on distillate, we're not too far from the top of the 5-year range for this time of year. Again, distillate is heating oil and diesel. Jet fuel is above the 5-year range for right now. Residual fuel is still a little bit below, but it's had an amazing recovery from the middle of the summer. So again, we have several more weeks of really strong refining throughput. We've got good margins for the time being. I think the Gulf Coast refiners are just going to continue to sort of blast this stuff out. They're going to continue to make a lot of product. Where's it going to go, especially, in this next week or so, while you still have time to try to, get it out of town on a colonial cycle before, um, before you get taxed on it here at the end of the year. So again, I think there can still be quite a bit of fireworks going on in that Gulf Coast basis markets. And again, from my perspective, what I'd be looking at is the January or February basis markets, not the December that's having all the issues right now. On the crude side of things, again, Gulf Coast crude is sort of in the middle of the 5-year range. We're doing better than last year. Cushing still remains below the bottom of the 5-year range. So things are really tight there. Again, this is where Cushing is where the futures are on the CL futures on the NYMEX or the CME. And so again, it should be relatively expensive. It's not, there's other issues going on there. But you would think that the Gulf Coast would be even cheaper because the Gulf Coast doesn't need any supplemental barrels coming down from Cushing. And you want to try to shut off that flow. So again, if the HTT market is too strong relative to Cushing, it sends the signal to, hey guys, you need to send light crude down the pipeline here to Houston because we're not getting enough. And that would draw on Cushing even more. So again, that's another reason why the HTT should be relatively cheap here for the next little bit. And again, trying to figure out a way to get long for the summertime when refining demand again returns to sort of max demand in the Gulf Coast and most of the rest of the world as well. So just to recap, is WTI bottoming out? We've had those two lows that we saw in the market previously. Is that going to count as a double bottom? I don't know. The end of the year should be interesting from a flat price perspective. Again, I think there's a lot of refining demand to go still between then and between now and the end of the month. So I'm thinking we get a little bit of strength coming out of that. There's a lot of geopolitical stuff going on, as you probably know, in the markets, which will also impact that flat price. So we'll see how that plays out. But again, I'm still leaning to the long side of the market, although this time of year it does get pretty tough. Hopefully I explained the basis markets to you, a couple of them. There's a lot of different basis markets on there. Feel free to ping me through the oil balance if you have more questions about various basis markets. Again, there's a lot. I only sort of covered two to give you some examples of what I was talking about. But go look on the CME website for yourself if you're interested, or ping me and I can help you out that way too. And then we looked at inventories. So New York Harbor is still pretty low in terms of the refined product inventories. Cushing is still low in terms of light crude at the NYMEX delivery hub there. Pad 3, we've got lots of it. And I think it's going to get even worse where inventories are going to continue to swell. And if you think about it from, your sort of stockpiling inventory for the lean times, that's what's going to happen from a refined product perspective. We do need to stockpile now. It should be relatively weak for the time being, but just keep in mind we're going to draw that down through that long period of time where we have planned refining maintenance going on. So hope this helps. I want to show you one other thing too real quick that I think is interesting here. If I can find my cursor. There we go. So I wanted to show you this real quick. Again, this is what I've been talking about in terms of putting the monthly data and the STIO data in terms of something that's usable. This is the propane spreadsheet, and these are just the charts from it. But you can sort of see, hopefully I've made some sense of it in terms of gathering all the data and putting it in a way that is digestible. So in other words, here's your propane stocks here. In your pad 3 stocks with the forecast in the red dashed lines. Then we come down to the supply side. So I have production, imports, total propane supply. Then we have propane demand and implied export demand. So again, putting these in a way that hopefully makes sense. I know I find the data hard to comprehend the way that the STIO has it laid out. So hopefully this is a better way of doing it. The spreadsheet does have the monthly numbers in numerical format as well, and I do have a history on what the different STIO numbers are doing. We'll be building a history in there, and have prices as well. Again, this is coming from the various CME groups. So if this is something that's interesting to you, planning on putting this out here in the very near future, product by product. So again, this is the propane one that I have ready to go for right now. If you're interested in that, hit me up on theoilbalance.com or let me know in the comment section too, and I can get in touch with you. But it's meant to be a way to quickly look at what the supply and demand inputs are doing, what the government is forecasting in terms of those supply and demand variables, and then what the government's looking at in terms of STIO as that inventory forecast. So hopefully you find that enjoyable, and we'll talk to you next week. Talk to you later. Bye.